Venture capital versus private equity. In this video, we are going to go over the differences between the two, why it's relevant to you as a founder or an investor or somebody just looking to learn about this world, and how you can maximize your outcome if you are going into do business with either of these groups. So from an overview perspective, what we're going to cover in this video is the similarities, the who, the what, the when, and the how each of these groups produce returns. And then what we are not going to cover in this video is the where or the why, the geographical or philosophical differences between the two. That's not what we're going to cover in this video. So let's go ahead and start with the similarities. The similarities from a fundamental perspective are that you have investors who have raised capital from groups with lots of money called limited partners. You could think banks or institutions that are going to invest in assets to produce a return on their fund, the capital that they raised, and then a surplus, that's their return on investment. So the next group of similarities that's important to mention is that they both want to invest in assets that have some predictable fit within their matrix of what they're looking to do to produce a return. So for example, they want moats or something that makes that company defensible or valuable versus the rest of the market. And they want it to fit a specific set of criteria. So we're going to throw similarities over to the side and get into these differences. So let's start with the who. To keep it as simple as possible, the who between venture capital and private equity. The who for venture capital is focused on fast growing, and 99% of the time it is tech-based companies who can scale extremely quickly. The reason is that the what, which we'll talk about later, is heavily influenced by the ability to scale a company extremely quickly. But for the who, for private equity groups, you can think traditional plus. Now, there are a lot of private equity groups that do invest in tech companies, but they are not limited to companies at all. They do things like real estate. They do a whole host of companies that are so different from venture capital that you could really think just about anything. That's what private equity groups can invest in, but they look at it differently in terms of when. So the when, to go back to venture capital, is they're looking for the earliest stage of companies all the way up to late stage pre-IPO, versus with private equity, they're open to, at the majority time, you're looking to begin at what they call the lower middle market. And the lower middle market is anywhere from 3 million in EBITDA and up. So your earnings before interest, taxes, depreciation, and amortization, which if you think about it, let's say you have an established traditional company that runs at 10% EBITDA, well, that's 30 million in revenue. So that is where we start to get into these vast differences between the two, and that starts with the who and the when. So furthermore from there, let's get into what. As I mentioned earlier with venture capitalists, they want to maximize the return potential, and they're willing to invest in a company extremely early. There are firms out there, they call themselves first check investors, or there are groups like that that are willing to be so early in a company, the company hasn't even been set up yet and definitely has no EBITDA, right? That is how early venture capitalists will get involved. And then it, grows and changes from there. They do look at numbers, later, let's say your Series A, but all in all, what they want to do is maximize the return potential, take as much high leverage, high value, speed to market, speed to delta on the difference between the competitor and that company. They just want to maximize the differences and exit that company as quick as possible, which means they're willing to take on more risk. Hence, you get into that difference in the failure rate. So the failure rate is, in venture capital, they expect about 75% of investments to not return what they invested, versus with private equity, it's a different risk tolerance where they want to see at least 70% of companies actually return what they invested and then some. So with that, let's get into how they provide value. So to keep it simple, venture capitalists look to provide what we'll call external domination. They want to find that hole in the market, capitalize on this emergence of technologies or new industry creation, new market creation that they can go ahead and take a hold of and create the dominant market leader. And they're willing to literally trash a company if they have to reach that point. That's where you get such a higher failure rate and the power law distribution, which means that the top 1% of venture capital companies that are venture backed, those are the ones who return the large majority of returns. It's sort of a exciting world to be in, if you ask me. But then from the private equity side, it's more operationally focused. So how they can come in and provide their economies of scale when it comes to access to capital or operations, hiring, different departments in the business, sales, marketing, synergies in their portfolios, both of which will leverage those. But you see what I'm saying? It's more internally focused and how they can maximize it, and then external. So now let's get into the further how, and actually just the one key differentiator, which I've mentioned, is they both want to optimize their entry. They want to maximize their equity value. They want to grow the company's revenue. But the key area where they differ is profit. And so a venture capital group is looking to say, hey, if we're going to take this number one position in the market, we probably have to run at a very low profit margin so that we can know we are maximally investing into infrastructure or technology or people or sales, whatever is going to scale the heck out of that company. And then with private equity, they actually want to maximize profit. Of course, they're willing to take the hit along the way up to that, again, uniting factor. They both want to exit, but private equity groups may have different strategies in which they achieve those returns or distributions. They may take more capital off the top in the interim, off that profit margin as a distribution for themselves and their limited partners, whereas venture capitalists do not do that in most cases. So that is how you can understand the differences between the two. Now let's just talk a bit about process. I'll over-deliver here and talk a little bit about process if you're going to go raise capital or engage with either of them. Starting with venture capital, the key difference is this one document, and that's the NDA. With venture capital, you will almost find nobody, aside from when you get in deep due diligence and they really want to know your IP or things that could be extremely risky or confidential to your business. That's the only point you'd ever really sign an NDA with a venture capitalist, but by and large, you do not. Versus in private equity, an NDA is almost one of the first things that you do. The reason why is that with your company that's at, let's say, 5 million in EBITDA, they might have a company that is directly associated or in a similar, maybe even a competitive stance, most likely not, but potentially, or something that's auxiliary or near to your company, that if they got information from you, they are pretty much willing to use it to maximize the value of the company, but they provide the NDA so that you know that you have coverage and you're, whatever you're going to share, you're okay to share. And then to take it a step further, what happens after that? So with a venture capitalist, you can watch the 40-minute super class on how to raise venture capital that I dropped. With that, you're going to go straight into a pitch call. Whereas after you sign an NDA with a private equity group, what's going to happen is they're going to want to send them the confidential information memorandum, which is a massive document which details that confidential information about your company that is about your strategy, how you're going to grow, how you're going to maximize, why you're looking for capital, what you're going to do with the capital, all those sorts of things. And then that understanding right there is one of the biggest differences for you to know. So let's just kind of run these both in dual channel so we can get to that point and contextualize it and then set ourselves up for checking out another video. So if you're going to go raise capital from a venture capitalist, you're going to get your data room and those sort of things in place. You're going to go create your pitch deck. You're going to do that outreach. And then from there, you're going to be engaging with investors who are probably going to hop on a call with you right away. Versus with a private equity group, you're going to do the data room. You're going to get your pitch deck together, but then you're going to make your confidential information memorandum, do your outreach, go reach out. You'll get interest. They'll ask for that NDA. Then you're going to share the confidential information memorandum and then go through those later processes. That's how they flow through. So this video is now concluded. I will see you all in a next one.